So now we're going to talk about accrual accounting. So accrual accounting is where the revenues and expenses are recorded in the period in which they occur, regardless of when the cash payment is received or paid. And this is how most businesses how they operate. So accruals are the accumulation of amounts that are owed but not yet paid, and then the amounts that are due but not yet received. A typical reason for personal financial failure or small business failure is not understanding accruals. People tend to think intuitively that an increase in cash represents an increase in wealth and vice versa. The notion of an accrual is recognizing how much you're worth at a point in time. So realizing that cash does not necessarily equal an increase in wealth. And so assume that you have $1,000 in cash and a net worth of 1,000. If you pay a $300 expense with cash, then your cash and your net worth are both going to decrease by $300. If instead you receive a phone bill for $300 to be paid next month, then there would be no change in the amount of cash that you have for the current month. However, the phone bill is an unpaid expense and has to be recorded even if it's not paid until a later date. And so it would become a liability. This is an example of accrual-based accounting. Recognizing this expense increases unpaid accounts by $300, and it would decrease our net worth by $300. Now, cash flow relates to cash flowing into and out of a bank account, which is not necessarily directly connected to net worth. If the cash is spent on an expense, net worth is reduced. If the cash is spent on an asset, one asset is exchanged for another, and net worth is not affected. Accruals relate to net worth, which do not necessarily connect to cash flow. In this example, since the bill is paid later, cash flow is not affected because we haven't actually paid the bill yet. We've just recognized that we have a liability that we owe it. So we see that so if the expense was to be paid now, it would decrease cash. Otherwise, if we pay it later, it would increase our liability. All right. Cash-based accounting is where the revenues and expenses are reported only when cash is received and paid. Since it is more straightforward than accrual-based accounting, individuals tend to use this method for their personal finances. An accrual-based accounting is where revenue and expenses are reported in the period in which they're earned or incurred. So suppose that you were to deposit a salary of $3,000 that was earned in January. Suppose that you also pay expenses of $2,000 using cash from the bank. The difference between revenue and expenses results in an increase in net worth of $1,000, the same as an increase in cash, because we have our revenue, which increases on our income statement of the $3,000, which is our paycheck. Then we have the $2,000 of expenses that we paid, our various bills that we paid for the month. And that would decrease cash, increase our expenses on our income statement. Now, suppose that you choose to charge all $2,000 worth of expenses to a credit card, which would be paid in February. When you use the cash-based system, your net worth appears to be $3,000 for the month of January. When you use accrual-based accounting, you need to recognize the expenses in January when they actually were incurred. So matching revenue to expenses in January increases net worth by $1,000. Cash remains at $3,000 because it hasn't been spent yet. But you have that outstanding liability because you put all that on a credit card. So now, examples of transactions using accrual-based accounting. So the little number one there is you earn and deposit 5,000 in salary. So your cash is going to increase by 5,000, which increases the total assets on the accounting equation. Net worth also is going to increase, which is shown by the revenue in the income statement. So we see that over in the green, the increase in revenue. Now we pay $1,000 in cash for food expenses. Cash is going to decrease by 1,000, and which decreases assets. Net worth decreases since food expense is recorded on the income statement. So we see there under food, we have an expense for 1,000. Then we record a $500 credit card bill for a vacation plane ticket that's due in 1 month. It'll be due the following month. Cash is not affected. However, you have a debt that must be paid next month. Debt increases liabilities and the expense reduces net worth. So we see that we have the 500 in the unpaid accounts. That increases our liabilities, and we see over in the expenses that we have to an expense for transportation for 500. We pay $1,000 for a new laptop. Cash decreases because we paid cash, but contents of home or assets also increase. And so our net worth doesn't change because we just traded one asset for another. Now we can also illustrate these transactions with the accounting equation to ensure that our assets equal liabilities plus net worth. Since cash increased by 4,000, you may think net worth also increased by the same amount. This is not the case. Net worth is affected by revenue and expenses regardless of when the cash is received or paid. The net worth account itself is rarely directly changed by a transaction. Some changes to net worth are actually recorded in the income statement. So watch that for when you analyze transactions. So we see there that everything works out. So if you were to record a $500 credit card bill for gas expenses that's due in 1 month, what is the effect to net worth? And it would decrease your net worth by 500 because it creates a liability for you.